Welcome to PlotLines, where we'll use our over 30 years of experience in real estate communications to uncover the real stories behind real estate. I'm Heather Crowell.
And I'm Britni Acriveau. Dive in with us as we invite guests to break down the ever-changing landscapes of real estate together.
Welcome back to PlotLines, everyone. Today we're joined by Brian Tortorella, Michael Tessitore, founding partners at Fidelis Investors, and they're joined by Jerry Howard, who's a special advisor to Fidelis Investors. Thanks for joining us, everyone.
Thank you. Thanks for having us.
Great. Well, why don't we start with introducing yourselves, telling us a little bit about your role, and how you got started at Fidelis and how Fidelis came to be.
Sure. So I'm Brian Tortorella, along with Mike Tessitore. We're the two founding members of Fidelis, which was started in 2020. We're based in New Jersey. At its core, we're a $1 billion asset management firm.
Okay.
We manage capital for endowments, foundations, insurance companies, hedge funds, et cetera.
Okay.
We are focused on residential credit. So specifically in the resi world, whole loans. Personally, I've been in the business for about 29 years. I spent a number of years on the sell side at places like Goldman Sachs, UBS, and on the buy side of 5 Mile Capital, and now eventually Fidelis, where Mike and I started it together.
Awesome.
Hey guys, thanks for having us. My name is Michael Tessitore. I'm a managing member of Fidelis Investors. I spent a career in mortgage credit at firms like UBS, 5 Mile Capital, Smith Graham, and then ultimately we founded Fidelis in 2020 along with Brian. Brian and I have shared experience over 20 years managing businesses specifically dedicated to residential home loans. They largely, our focus is on the residential transitional space. With a focus also on new construction loans and institutional capital to residential deals throughout the United States.
Okay.
And I'm Jerry Howard. I am a special advisor to Fidelis. My entire career has been in the housing sector. My dad was a builder developer. I became a real estate lawyer and went up to Washington and focused my career really on housing and real estate policy, culminating in a 23-year stint as president and CEO of the National Association of Home Builders.
Okay. Awesome. All right. Thank you all for doing those intros. That's really helpful for us and for our audience. So the PlotLines podcast, as you all are aware, is all about dissecting headlines in the space and giving you the opportunity to give your perspective on them, rewrite them. So a lot of headlines right now are looking at the role that institutional capital is playing in the housing market. Is it making it worse? Is it making it better and keeping things moving? I'd love to hear your thoughts on all of that, and whoever wants to start can jump in, and you all can kind of weigh in from there. But we'd love to start here.
Okay, great. Yeah, I think I'll take it. I think the answer to the story is probably somewhere in the middle.
Okay.
There clearly is a need for private capital in the space. I mean, bank regulations make bank lending at times not so efficient. And on top of that, you have different types of assets that need financing, whether it be new construction or fix and flip or bridge loans or whatever it might be. So there's definitely a need. The question is does private capital and really institutionalizing the space lead to enough quality assets? Because as you know,
right.
If liquidity floods into a space, that's a good thing. But then you also need enough quality assets to meet that demand. And I think kind of what we have to see. The market, I think there was about, for instance, in the fix and flip market, about $50 billion worth of financed fix and flip assets last year. So
nationally, Brian?
Billion. Is there $100 billion worth of quality assets out there? I think that's to be determined. I think that's what we have to kind of figure out.
Right. And that stat you were referencing, Brian, that's nationally?
Yeah, that's national. I mean, we do, hey, Mike, I mean, you can weigh in. I think we do. There are differences regionally. For instance, in some regions that probably are in need of more institutional capital than others.
Yeah,
And what are we seeing in the portfolio?
no, I think that's right. I mean, I think that there, good lending starts with a need, right? And I think the need here is with alternative financing, right? And so alternative financing needs to fill the void of where traditional banks and sort of the government sponsored entities are missing, right?
Yep.
And that's construction lending, that's residential transition lending, fixed income lending. And so you got to make sure, I think, look, there's obviously a need for this alternative financing. It's just about meeting the right need and then deploying that capital responsibly.
Yep. That makes sense.
I mean, nature abhors a vacuum, and there's a demand out there in the hinterlands for capital that's not being met by the conventional banks. In many instances, as Brian said, it's being squeezed by overregulation. And so it's only natural that the private sector and private capital would fill that vacuum. I think it's not only more of a good thing than a bad thing. I think it's a necessary thing.
Yeah. So you spoke a little bit about that. You used the term alternative financing. And I think for our listeners, it would be helpful to describe what you mean by that in terms of the work that you're doing. Like how would you define alternative financing to our listeners?
I think alternative financing to us at Fidelis just means capital solutions that are outside the box of, again, of the traditional banks and government-backed lenders. I think it's important to note that we're not talking about a substitution for that type of lending, but more of a complement to that type of lending. I think it's about filling a void, right? And at Fidelis, for us, that means deploying capital into the construction lending space, the fix and flip space, because those are spaces where the traditional lenders are just typically not playing.
Yep. And are you? Go ahead.
If you're banks are in the business of underwriting credit and underwriting 30-year loans on owner-occupied homes, like that's just traditional bank. But there's a whole world outside of that, especially with the fact that I think we'll probably talk about at some point in this podcast, but you have aged housing stock, it's tough to build and turn a profit in some areas.
Yeah.
So all of these other channels that have to be really sourced. And I think that's, where alternative financing is really coming into play.
Yeah.
I think it needs to meet the needs of the borrowers, right? And so I think borrowers in the transitional space are in need of speed, they're in need of flexibility, they're in need of efficiency, right? And really what they're in need of is a partner, right? More than even a traditional lender. And so I think that's where private credit and firms like really come into to supplement the traditional bank lenders.
Yeah. No, that makes sense. Are you lending in like individual deals or portfolios? Like give us a little bit of context in terms of how you're finding deals.
Basically, we will purchase, let's call it bridge loans. They're called RTLs, resident transition loans.
Yeah, we're familiar.
At the end of the day, it's a bridge loan, right? Builders come in, they're looking to fix up a property, renovate it, sell it, rent it, whatever they're going to do.
Yep.
We basically run the gamut. So we will purchase assets from small, medium-sized lenders around the country, and then we also direct lend to these same types of borrowers. So whether it's direct, to the individual deal and or through a lender, we have access really across the country.
Okay. All right. So we talked a little bit about the headlines and the skepticism that's out there. How are you all responding to that in your roles? Talk to us a little bit about what those conversations look like.
Well, I think we try to stay ahead of everything. So for instance, if you talk to us 6 months ago, I think blanketly we would be able to say that housing supply nationally was pretty muted, right? I mean, that was pretty obvious. And as a result, whether we're lending and or purchasing or whatever we're doing, we could pretty much do it really in most areas across the country. I think that's changed now, especially over the last 2 or 3 months, in that it's a little bit more regional. So if you look at areas of Florida where there's been a lot of building and there's a lot of supply, that market's different. If you look at Austin, Texas, or some of the other areas of Texas, same thing. If you look at the Northeast or the Midwest, there's limited supply. So what we try to do is stay ahead of, where there really is a need for alternative financing, right? And clearly there's a need where supply is somewhat limited. And like I said, that's kind of shifted over time.
I mean, I think, look, I think we understand the skepticism anytime there's private credit involved. I think especially since 2008, I think that people are worried about transparency. They're worried about alignment. They're worried about the long-term impact of capital entering into the housing market. I think that's sort of left over PTSD from the housing crisis. But I think it's about providing a solution. And so when we think about our loans, like our loans are providing quality housing. I think we're improving each housing stock. I think that there are times where we're providing homes that go to students. There are first-time home buyers buying our property. So I think it's really about what we would consider solving a need. And so I think we believe that kind of well underwritten private credit as it enters the housing market is really good for sustainable growth in the housing market. And so I think that's where we're positioning ourselves over the next several years. And I think that's sort of our opinion on how it all sort of plays in.
Makes sense.
Yeah.
And you mentioned inventory and how even that's changed regionally over the last few months. Are there any other shifts you guys are tracking right now? I know prices are still such a hot topic in the housing market, but what other trends are you all seeing?
Yeah.
Well, look, I think that we're obviously keeping an eye on rates, and we're obviously keeping an eye on tariffs. So those are really the hot issues of a couple of months, because although, for instance, in Florida, inventory is up, if rates were down at 3 or 4%, that probably would be a different story. So I think what you have a lot of borrowers essentially sitting on the sideline, because from a tariff perspective, there's just uncertainty.
Right.
Rate perspective, to lock in at 6 3/4 is difficult for them to do. So I think those are kind of two of the unknowns. I mean, we could sit here and try to project rates. I think that we wrong.
That's okay.
But I think those are two things that we're kind of keeping our eye on, at least relative to housing.
Okay.
But I think you have to remember that of all of the major economic drivers in our country, housing is the most localized one.
Right.
Every housing market is different, and it depends on the local economy. It depends on the local politics, and then everything is overlaid by the state politics and the national politics. So you really have to do, and I think at Fidelis, they are undertaking a very, very thorough analysis of all the elements of a local market before you get involved in it. And that is a difficult undertaking.
Yeah.
Anything was learned from 2008. It's that it's not one national housing market.
That's right.
It can't be treated as such.
Micro markets, And we'd love to hear a little bit more about the data you're looking at and the research you're doing. But before we move off of you, Jerry, you spent decades on working on housing policy. What is the government or the public generally not understanding or not seeing about how, housing is financed?
I don't think that the average housing consumer understand the difficulty in putting a new house on the market. The process that a builder has to go through to get the acquisition loan, the development loan, the construction loan, all the permitting.
Yeah.
Everything
just happened.
And the average consumer just sees a house on the market. This is what it costs. It can't cost this much. Well, every layer of cost that's applied. And that I think that the housing consumers have to become more well-educated on that component of it. And it's true everywhere, although some parts of the country, it's much less bureaucratic. And gee, what a shock, they have more housing affordability than places where, like in San Diego County, California, 50% of the cost of building a new home is regulatory compliance.
Wow.
Which is why in places like Southern California, you have housing haves and housing have-nots. There's no first-time home buyer market. There's no middle income buyer market. It's all a function of layers of cost.
Yeah, those barriers to entry are just too steep, I guess.
Yeah, that's interesting. I mean, we've hit on a few markets already, but are there ones that you're more bullish on versus ones that you guys are steering clear of?
Yeah, I mean, I think that we, given kind of all the metrics, I think the Northeast and the Midwest are probably the best markets as far as pricing is concerned and as far as just demand or the supply balance. I think those are probably the best. I mean, California has pockets that are good and pockets that are not so good. I think Jerry kind of referred to that. I think, just as a, should kind of piggyback off of what Jerry was saying, is that from our seat at least, home builders are looking to build homes that are affordable. Like, that's what they want to do. And I think we've been to plenty of meetings with them and government officials where the two sides are trying to hammer out, how do we actually do this? And it's because it's local, right? And there's all these different local regulations. I think on our end, what we're seeing is that that's being supplemented really through aged housing stock. It really, you have areas. So for instance, I'll talk about the Northeast, Midwest, those areas, there's not a lot of room to build, right? So you meet the supply. The only way you meet it is through renovating housing.
That's right. Yeah.
And I think that is a lot of where we're seeing alternative financing is in that aged inventory. I think the number is somewhere around close to 50% of the U.S. homes are 44 years or older, right?
Wow.
So that's a big chunk. And in order to kind of meet this supply demand imbalance, the only thing you could do is either renovate homes or infill, which is knocking down a home and the street. So I think that's some of the trends that we're seeing in what we do on a daily basis.
Yeah, that makes a lot of sense, actually. That's a surprising statistic that I kind of flinched at that over, I think you said 50% of the homes are 44 years or older.
44 years or older.
Which I think in that process you called me aged, but that's fine. So that, I mean, that's interesting. What is a successful borrower relationship look like for you guys? What's the ideal characteristics of something you want to lend into, and what's the outcome, right? Because you're not the owner of the property. What's the outcome for you, your investors, and your borrowers?
I mean, so I think for us, we're looking, when we define borrower success, we're defining borrower success by a borrower who's involved in a project, who's on time, who's making timely payments, who's completing the project within the expected, that's moving the project along in a timely fashion, and ultimately is able to resolve and liquidate that property. That plan. So if it's a new construction building, we want to see them build a new construction home and sell it. If they're building a rental property, we want them to be, or they're building a rental property, we want them to build that portfolio and be able to rent those homes. If it's an RTL, we want them to be able to fix and flip the property, right? I think from our standpoint, we want to provide them with the flexible, make sense underwriting, right? And the loan, so that they can finish the project and be able to enhance the project in a timely fashion.
Right. So that doesn't always happen, I guess, right? We wish it did. What happens, or how do you work through it when a project doesn't stabilize in the right amount of time, doesn't liquidate? There's not a liquidity event. What are the options at that point?
There are always issues. I think for us, it's about taking a proactive approach with the borrower, right?
Okay.
Making sure that we're in constant contact with borrower where there are issues, understanding what's going on with the draws, right? Many of our loans have a draw component and a construction component to them. Ensuring that we know if a borrower is having issues and stepping into those issues early, right? And so what does that mean for us? That may mean potentially partnering directly with their subs, right? Making sure that payments are going directly to the guys who are doing the work and completing these projects.
Right.
In certain instances, us at Fidelis taking over that project ourselves and getting it completed and getting it on the market.
Okay.
I think what we're really talking about is loss mitigation, and loss mitigation, takes several things. But I think ultimately the solution is getting to issues early and understanding what the problems are and being able to resolve those issues.
I think there's a big difference between, we lived through subprime and there's a big difference. In 2008, you were dealing with owner-occupied homes, people that have been in those homes for years. there was a ton of HPD, the market crashed, and now you had foreclosures and delinquencies ramping up, but the people didn't want to leave the house, right? The people, that was their principal residence.
Yeah.
But in a lot of the alternative financing now, whether it's a fix and flip on a single family home or whatnot, a lot of these are business purpose loans. So the builder or the borrower is getting into this as an investment.
Right.
And maybe halfway through their investment, it's not working out like they thought. And now between them and us, there's a business decision to make, whether it's taking money off the table or whatnot. I think that's lent itself to some better resolutions that we would have seen on the owner occupied side.
Yeah, that makes sense. You have the same objectives, right? So
Yeah.
Okay.
I think in this space, you're really trying to be more of a capital partner. And I think you're trying to put the borrower in a place where they win and they can get out of these deals profitably, and then we all sort of win at the project.
Yeah.
Okay.
That makes sense.
Jerry, maybe back to you quickly to talk about sort of like this marriage between policy and institutional capital. I mean, what does that alignment sort of look like to you? Like, what can the industry sort of be on the lookout for and learn from that?
Well, I think that this emerging component of the housing finance market is based upon finance policies and housing policy that have impeded what these guys call traditional housing finance. And I think that the marriage is based upon the vacuum that's created in the marketplace by these types of policy decisions. Until and unless policymakers start to look at housing policy and financial policy and labor policy and environmental policy,
Right.
and export policy as intertwined and interconnected, you're going to end up having unintended consequences across the board that create vacuums for creative thinking in the marketplace. I don't see that policy cooperation between different elements emerging or strengthening anytime soon. So I think these guys are cutting edge, bringing this new product to the marketplace, and not just bringing a new product to the market, underwriting it properly, creating the right synergy between the borrowers and the investors. And I think it's going to only grow in the future.
Mm-hmm.
Yeah. Okay. Before we sort of wind down here, talk to us a little bit about the RTL securitization that Fidelis recently executed that I think supported the rehab of over, I think 500 is the number, 500 homes. Talk to us a little bit about that, how that came together, and what, if anything, that signals for the broader market.
Yeah, sure. I mean, we in 2013, there was not a secondary market for RTLs. It didn't exist. You basically had family and friends on a local basis pulling their money together and lending in their own backyard and holding on to it and generating a yield. We, at the time, were at a private equity firm called 5 Mile Capital, and we, along with a couple of our investors, trying to institutionalize that market and actually create the secondary market. The way we did that was we started buying loans from these smaller local lenders, and that gave them the ability to go out and lend more and scale their business.
Okay.
And we did that for a few years, and there were other counterparties that came in and started doing it as well. In 2016, Wall Street came into this business, which meant that leverage came into the space.
Yeah.
And we had other private equity firms that were utilizing leverage to do the same thing, purchase these assets that further institutionalized the business. In 2020, the first unrated securitization came out. I think it was 2020 came out.
Okay.
And finally, 2024 was the first rated RTL securitization, which I think is really the culmination of institutionalizing a market where that just didn't exist 10 years ago. Now you got insurance companies, hedge funds, private equity funds that are all involved in the space. And you also have a rating agency that's rating the asset class. So I think it's really the culmination of what all the market participants have tried to do for the last decade.
So you think we'll see more of that, I guess?
I mean, I don't know, Mike.
We're certainly headed that way. I think it's like I think Brian touched on it, but it's really about matching institutional capital with a lending need, right? And so I think securitization provides that avenue to
Right.
investors to participate in a way that they otherwise would not be able to. So I think we will continue to see the growth of the securitization market in the arts construction space.
All right. Okay, well, that brings us to sort of our closing remarks here, which is where we turn it to the three of you to sort of write what your ideal headline would look like for the housing market right now. So you can each take a stab at this. Again, what you would like to see in the press if you had the opportunity. Mike, maybe we'll start with you, and then we'll work our way down.
Yeah. I guess for us, I think it would be alternative financing unlocks value for real estate investors. I think that's very much what it's about for us.
Cool.
Yeah, I think, all right, I'll take the opposite side. I think I go back to kind of what I said in the beginning is, will the additional liquidity in the market produce enough quality assets, for buyers like ourselves or lenders or whatnot? I think that's really, that's really what we have to figure out.
Okay.
My headline would be, housing demand provides sound opportunity for private investment.
Okay.
I love it. You all thought through that. Thank you.
Yeah, and they were varied enough.
Yeah.
Now we have 3 great headlines to work from.
Awesome. Well, before we take off, is there anything any of you think we didn't cover that our listeners might want to know?
I don't think so. I think you guys. I think you guys.
Great.
Yeah.
All right. Well, we really appreciate all of your time. This was really
Thank you
insightful.
for joining us.
This podcast is a production of Gregory FCA. If you enjoyed our discussion, please subscribe wherever you listen to podcasts